If you asked a room full of economists whether lump sum investing or dollar cost averaging is better, most of them would give you the same answer. Lump sum wins. In fact, when researchers studied decades of market data, they found lump sum investing outperformed dollar cost averaging about 2/3 of the time. So, logically, the decision should be simple. Invest your money immediately and let it compound. But here's the strange part. Even knowing that, a lot of experienced investors still choose dollar cost averaging instead. They invest slowly, month by month, paycheck by paycheck. So if lump sum wins mathematically, why do so many disciplined investors still prefer dollar cost averaging? If you're earning a strong income and trying to build real wealth, this question shows up more often than people expect. Maybe a bonus hits your account. Maybe RSUs vest. Maybe you just built up a large amount of cash sitting in savings. And now you're staring at the same decision a lot of smart investors wrestle with. Do you invest the money right now or spread it out slowly over time? Because if you invest everything today and the market drops next month, you'll wish you had waited. But if you wait and the market climbs while you're sitting in cash, you've just lost time. Time your money could have been compounding. And over a 20 or 30 year investing career, those small timing decisions can quietly add up to a massive difference in wealth. In this video, I'll show you why lump sum investing actually beats dollar cost averaging most of the time, why many successful investors still prefer dollar cost averaging anyway, and how high income professionals can combine both strategies to build wealth faster without constantly second guessing when to invest. Before we get into the numbers behind the debate, there's a simple way to picture the difference between these two strategies. Imagine you walk into a tall building and you need to get to the 40th floor. You have two options. You can take the elevator, which gets you there almost instantly, assuming you step in at the right time and nothing goes wrong on the ride, or you can take the escalator. The escalator moves slower, floor by floor, step by step. But once you step on, it just keeps moving upward. You don't have to time it. You don't have to think about it. You just get on and it carries you along. That's essentially the difference between lump sum investing and dollar cost averaging. Lump sum is like the elevator. Your money goes in the market all at once. Dollar cost averaging is the escalator. Your money moves into the market gradually over time. And here's where it gets interesting. Because even though the elevator is usually faster, a lot of investors eventually realize they prefer the escalator. Let's start with the numbers, because this is where the debate usually begins. Imagine you receive a large amount of money to invest. Maybe it's a bonus, maybe you just had some company stock vest, maybe you've just built up a large cash balance in your savings account. Now the question becomes, do you invest all the money at once or spread it out over time? Most investors assume spreading it out must be the safer route. It feels cautious, it feels responsible, but mathematically, there's a hidden cost to delaying your investment. And the reason is simple. Markets tend to rise more often than they fall. Since 1928, the US stock market has finished the year positive roughly 3 out of every 4 years. So when you invest sooner, the money simply has more time in the market to compound. That's why multiple long-term studies have found the same result. Lump sum investing beats dollar cost averaging about 2/3 of the time. Not because it's smarter, not because it predicts the market better, but because the money gets invested earlier. And when it comes to investing, time working for you is incredibly powerful. Here's a simple example. Let's say you have $120,000 ready to invest. If you invest it all today, that entire amount starts compounding immediately. But if you spread it out over the next 12 months, a portion of that money sits in cash the entire year. And if markets rise during that time, the delay quietly reduces your long-term returns, which leads to one of the most repeated phrases in investing for a reason. Time in the market beats timing the market. Now, here's where the math and human behavior start to collide. Imagine this. You invest $200,000 today. You feel good about it. Your money is finally working and you're thinking long term. Then, a month later, the markets drop 30%. Suddenly, that $200,000 is worth something closer to $140,000. Even if you understand that markets recover, that moment still hurts. And that reaction isn't a lack of discipline, it's human psychology. Researchers studying behavior and decision making discovered something interesting about how we experience gains and losses. We feel losses about twice as strongly as we feel gains. In other words, losing 50K hurts far more than gaining 50K feels good. This idea is known as loss aversion, and it plays a huge role in how investors behave. Because when someone invests a large lump sum right before a market decline, they experience something behavior economists call sequence risk at entry. The loss happens immediately, and that immediate loss creates stress, second guessing, and sometimes panic. And that's exactly why lump sum investing feels so risky. Because when a decline happens right after you invest, it's not just a number on a chart, it feels personal. And that emotional experience is why many investors prefer a different approach entirely. Instead of making one big decision, they build a system that invests automatically over time. Now, here's where dollar cost averaging starts to shine. Because while lump sum might win the math most of the time, most people don't invest with a single pile of money once in their life. They invest with paychecks every 2 weeks, every month. Money comes in, and the question becomes, what do I do with it? And this is where a lot of investors run into trouble. Because if investing requires you to make a decision every single time, eventually life gets busy and the market feels uncertain, the headlines get scary, and the decision gets delayed. So the money sits in cash, or it gets spent. Not because the investor doesn't believe in the market, but because decision fatigue is real. Dollar cost averaging solves that problem by turning investing from a decision into routine. Instead of asking, should I invest right now? The system simply invests automatically, month after month, paycheck after paycheck. And over time, something interesting happens. You stop thinking about whether you should invest. You simply become the kind of person who always invests. I once worked with a client who had a very simple rule. Every 2 weeks, the day after his paycheck hit his bank account, money automatically moved into his investment account. After a few years, he told me something interesting. The biggest benefit wasn't actually the returns. It was that he stopped thinking about investing altogether. The system made the decision for him. And over a 20 to 30 year career, those kinds of systems often outperform good intentions because consistency compounds just like money does. Now, there's another risk that shows up when investors delay putting money into the market. And this is one most people rarely think about because waiting to invest feels cautious. It feels like you're protecting yourself. But in many cases, the bigger risk isn't investing before a downturn. The bigger risk is missing the recovery afterwards. This is something I see fairly often. Bonuses come in, RSUs vest, cash builds up again in a checking or savings account. And the plan is usually the same. I'll invest once the market settles down. But the problem is markets rarely send a signal saying, okay, it's safe to invest now. In fact, some of the best market days happen right after the worst ones. Research looking at long-term market performance shows something surprising. If an investor stays fully invested over a 20-year period, they might earn something like 9 to 10% annually. But if they just miss 10 of the best trading days during that same period, their returns could drop closer to 5 or 6 per year. And here's the catch. Those big positive days often happen during periods of maximum uncertainty, which means investors waiting for things to feel better frequently miss the rebound. So when you put all this together, the math, the psychology, and the habit side of investing, most experienced investors don't actually treat this as an either-or decision. They end up using both strategies. Think of it like 2 different lanes in your investing plan. The first lane is dollar cost averaging. This is what happens with your regular income. Every paycheck, money automatically moves into your investment accounts. Your 401k contributions, automatic brokerage deposits, monthly Roth or taxable investments. This is the escalator we talked about earlier. It just keeps moving. no timing required. But then there's the second lane. That's where lump sum comes in. Things like a large annual bonus, a big RSU vesting event, or a large amount of cash that's just built up over time. Those moments create opportunities to put large amounts of money to work all at once. And this is where having a clear plan becomes incredibly valuable. Because without a plan, large amounts of cash often end up sitting on the sidelines for months or even years. Now, after all this debate about lump sum versus dollar cost averaging, there's an important perspective that often gets overlooked. Because the difference between these two strategies is actually pretty small compared to something else that matters far more, your savings rate. Look, if someone is deciding between lump sum and dollar cost averaging, they're already doing something right. They're investing. But when we zoom out and look at what actually drives wealth over a 20, 30 plus year career, the biggest factor usually isn't how frequently you invest. It's how much you invest. For example, imagine a household earning $400,000 per year. If they increase their savings rate from 20% to 25%, that's an additional $20,000 invested every single year. Over 20 years, assuming something like a 7% return, that extra $20,000 per year could grow to nearly $870,000. Not because of perfect timing, not because they chose lump sum or dollar cost averaging, but because they consistently invested more money over time. And that brings us back to the real goal here. The best strategy isn't the one that wins the academic debate. The best strategy is the one that keeps you invested consistently for decades, through bull markets, bear markets, recessions, and recoveries. Because in the long run, discipline usually beats perfect timing. And this idea of building a clear investing system becomes even more important when your wealth starts concentrating in one specific place. For a lot of high-income professionals, that place ends up being company stocks. RSUs vest, stock options accumulate, and before long, a large portion of your net worth is tied to the company you work for. Which raises a really interesting question. Should you sell that company stock and use the money to pay down your mortgage? Or hold on to the stock because it could continue to grow? Because depending on the situation, both decisions can make sense, and both can also create risk people don't always see coming. So if you want to understand how to think through that decision, watch this next video.